After the hedge funds, private equity firms, and investment banks are done creating shareholder value, is society any better off? Furthermore, could finance actually be a force for good in this world? Or is the greed of Wall Street always going to win out? Today, we are going to talk through 12 different careers in finance and rank them based on their contributions to society. Hello friends, if you're new to this channel, my name is Kevin Yang and I spent years working across Wall Street and Silicon Valley in investment banking, private equity, venture capital, and ultimately impact investing, after graduating from business school at the University of Michigan as valedictorian of my class. This channel exists to help you land your dream job in business and finance, especially in careers that make a positive difference for people and planet. So let's dive in. When I'm thinking about contribution to society, I'm mostly thinking about it in terms of if business goes well, who stands to benefit? And is that benefit broad or is it very narrow? And for those that are impacted, is it positive, is it negative? So this list is obviously very subjective. Many answers are correct. But for me, starting us off at the very bottom of the list at number 12 is quant trading, or otherwise known as algorithmic trading, prop trading, or high frequency trading. And number 11, hedge funds. Let's define each first before we get into the contributions. Hedge funds, this is an easy one. You can think of them as your stock pickers. You are either long a stock or short a stock. You think the share price is going to increase or you think the share price is going to decrease. Quant trading, on the other hand, basically has an algorithm and just hundreds to thousands of different market signals. Anything you can think of, from general market news to press releases to earnings reports and bid-ask spreads. And it takes that and the algorithm will execute the trades itself. Quant trading is a very high volume business where you move a lot of money and you make just a little teeny bit on each trade. And if you're doing this all day, you can make a lot of money. Now, I think the problem when it comes to contribution to society for both quant trading and hedge funds, which work in the public stock markets, is that it's all secondary capital. All that work, all that investing is secondary capital, meaning that when they make an investment, that money is just being transferred from one owner to another owner to another owner. And the company itself that's being invested in doesn't actually see any of that money. As compared to primary capital, such as an initial public offering or a new debt offering, the company can take that and invest it in growth. Maybe that's hiring out a new team or investing in R&D to make a product or service better for the customer. Hedge funds and quant trading, all secondary capital. And when they do well, they are making money from themselves and they're making money for their limited partners. That is the investors in the fund. And that's good, but I wouldn't necessarily call it a broad societal contribution here. And the only reason I have hedge funds ranked above quant trading is that hedge funds on occasion will participate in an IPO that is a primary capital issuance. Up next at number 10 and number 9 on the list are two divisions within an investment bank: equity research and sales and trading. Now note, they're divisions within an investment bank, but they are not investment banking itself, which we're going to come back to later. So starting off with equity research is basically stock analysis. As an equity research team, you basically put out reports on different public company stocks and issue a buy rating, a hold rating, or a sell rating. You do the analysis, but you don't actually do the investing. Now, helping people figure out what to add to their portfolio or what to drop from their portfolio is helpful. But the thing is, equity research is not particularly accessible. The reports cost thousands and thousands and thousands of dollars, and they stack up really quickly. And so unless you work for a large financial institution that has a corporate account, you probably don't have access to the equity research. Now for sales and trading. Sales and trading, you are effectively serving as a market maker for institutional clients. So say a hedge fund wants to take a $50 million long and buy position on a particular company stock. The investment bank helps them to execute that trade because $50 million of sellers isn't necessarily immediately there. And so the investment bank helps facilitate that trade and build up that position. And in doing so, they're going to take money from the bid-ask spread. Now, the hedge fund could technically do this themselves, but they're trying to buy low, and so it might not happen at the lowest average buy price. And so the sales and trading team makes this market a little bit more efficient. And that incremental market efficiency, that's good. Efficient markets are good. The next two fields on the list are private equity and venture capital. Now, venture capital is technically a form of private equity because private equity just means, well, private is not public and equity means ownership. So any ownership stake in a company that's not public is private equity. In venture capital, you're acquiring small ownership stakes in early stage companies. You're spreading your eggs across a lot of different baskets, but that's not what people mean when they talk about private equity. When people talk about PE, they are almost exclusively referring to late-stage private equity. This is with your leverage buyout, buy a company using debt, you're gonna pay down debt over time, and then you're gonna sell the company back off in 5 years. And you are becoming a majority, if not 100% owner in that company. Your investment thesis is the company itself. It's a very concentrated portfolio. Now, it definitely feels a little weird to have private equity as high on the list as it is at number 8, because private equity can do a lot of bad things for a lot of stakeholders. There's this headline stat from researchers at NYU and Wharton that they found that for nursing facilities, after private equity got involved, there was a 10% spike in the mortality rate, in the short-term mortality rate of patients, which that's terrible. And that doesn't even begin to talk about lots of negative things about private equity. By the way, if you're interested in learning more about private equity and whether this clearly broken system can be fixed, I have a full video out on my channel. So what about where private equity is doing well? So technically, private equity is employing like millions and millions of people, even if they're not a particularly great employer. I think private equity does have to exist in some manner. There's not that many parties that are interested in buying a company out of bankruptcy, but private equity is, and that company continues to provide its services rather than just liquidating entirely. Like, that's a good thing. And PE firms, they do make operational improvements at companies as well. Like, I want to be clear that this is not the bread and butter. That's not what makes an investment thesis work. And that is debt and that is leverage. So begrudgingly, I put this at number 8. Venture capital. Let's start with the bad and then go to the good. The venture capital business model is so boom or bust. And I think it creates really perverse incentives across the ecosystem. A single fund might have 30 different portfolio companies in it. Now, the boom and bust nature of it is that 29 of those firms might go bankrupt, 0x, no return, lose all your money. But if one of those investments is a unicorn and hits a 100x return, then you, for the fund overall, you've more than tripled your money. With VC in conjunction with the tech industry, who asked for these AI overlords? VC and tech are pushing artificial general intelligence on us, and whether or not it turns out to be good or bad for society, it doesn't matter, because it is a huge economic opportunity to make money. I mean, let's just say that there's a reason that they've earned the nickname vulture capitalists. But I do want to give VC credit where credit is due, because VC actually does a lot of work in supporting the early stage innovation ecosystem. Now, think about the alternative to VC. If you're starting a business and you need capital to grow your business, where do you get it from? You could look towards family and friends, in which case you need family and friends that have a lot of disposable income to invest in a riskier early stage startup, which isn't the case for most people. Or you would have to go and get a loan from the bank, which is kind of a clunky process, and banks aren't always known for deploying that capital quickly or fairly or without bias, and so placing it at number 7. As a quick aside, if you're feeling generous and are enjoying this video, dropping a like really goes a long way in helping out new creators like myself. Next up at number 6 and number 5, we have wealth management and asset management. Now, these two fields are similar, but definitely uniquely distinct from one another. In asset management, you are working on managing a portfolio of assets, typically on behalf of some institution, say for a pension plan or an endowment. Wealth management, on the other hand, works with families and individuals as the clients and goes beyond the portfolio to things like taxes, real estate, and generational wealth transfers to manage your wealth holistically. Now, the reason I have wealth management below asset management is because if you think about the business model viability for wealth managers, it's a percentage of AUM, or assets under management. So you typically take one of two paths. The first being you are a very high touch and high service provider to ultra high net worth individuals, or alternatively, you could be a very low touch and low service provider to many people. Managing one's wealth is a great thing. Wanting to secure a future for your children or your children's children is a fantastic thing. But the thing is, a lot of wealth is concentrated in a very narrow band of people. The top 1%, the top 0.1%, and even the top 0.01%. And there's a case to be made that this work makes the rich richer and worsens income inequality. But the overall picture is that wealth management can apply really broadly to a lot of people, and that's why I have it ranked number 5. Now, asset management can be very broad. I mean, a lot of different things, but I'm thinking about it a little bit more from the institutional side in pension plan managers and endowment managers. And if you're an asset manager at a pension plan, you are doing good work. because your work means that maybe a teacher, maybe a police officer, maybe an auto worker has a pension that they're going to be able to retire with once they reach that age. And that's really important work to be a steward of their capital. Similarly with endowments, say it's an endowment at a foundation, that foundation is looking to provide grants into perpetuity. And if you're growing that capital base, it allows that foundation to continue to deploy grants and give back to a community. So we're working our way up the list here. And number 4, we have investment banking. And number 3, we have corporate finance. Now you might be thinking to yourself, how can investment banking possibly be ranked at number 4? Because didn't the investment banks cause the 2008 financial crisis? Yes, but the function of investment banking itself wasn't what caused it within the broader investment bank. So the function of investment banking itself is all about serving as a financial advisor to companies, primarily on mergers and acquisitions, as well as in capital financings. M&A, you're helping a company buy another company, or you're helping a company sell itself. And in capital financings, you're basically helping companies raise money, either through the debt markets or the equity markets. Now, I think this role is important actually in finance because say you're a founder that's built their business and you're ready to retire, you're ready to exit, you're ready to hand it off into the next stage. And if you're looking to sell your business, the investment bank is serving as an advisor to you to help you get the best outcome possible for yourself, as well as for all of your employees that likely have vested stock in the company as well. Now, on the financing side of things, we talked a little bit about secondary capital earlier, but investment banks are working on facilitating primary capital transactions. That's where the money is going towards the company that can subsequently be used to invest in growth. Now, investment banking certainly has its blemishes too. For starters, if you work in investment banking, do not say the M word, monopoly. The running joke in investment banking is that you're working with these companies to help acquire other companies or consolidate market share, and you continue doing so long as you're able to get it through antitrust regulations. Perhaps you've created an M word, and if the FTC, Federal Trade Commission, suddenly decides that the company is a monopoly, then it would declare that the company needs to break itself up into smaller pieces. And so the investment bank that made money along the way for helping out on all these acquisitions is now going to make more money again in breaking up the company itself and helping with its divestitures. So on good and bad in banking, you win some and you lose some. Corporate finance is another very broad umbrella term, but it basically means you work in finance at a corporation. And this can take a lot of different roles itself. It could be in financial planning and analysis, that's FP&A. It could be in corporate development, which looks like M&A in-house. It could be in treasury, which is managing cash, or it could also be in strategic finance, which is a buzzy word in growth stage companies right now, but I don't know, basically means you help people make decisions with numbers. Now, companies are able to exist because they're providing something of value to somebody else or to some other business. Economic growth happens over time because of all of these companies, large and small, contributing and making valuable things and solving pain points for one another. And so corporate finance has a lot to contribute to society. But the obvious caveat here is that not all companies are really good-hearted or mission-aligned. And you could be working in corporate finance for a company that does something like sell tobacco or payday lending or multi-level marketing, in which case the corporate finance work you're doing is probably not quite as beneficial to society. Okay, we are solidly on the podium now. Coming in at number 2, we have consumer banking. These are the banks that you're familiar with. It's the Chase of JP Morgan Chase. It includes other banks like Bank of America, Wells Fargo, Citigroup. Consumer banking plays an incredibly important role for society, namely in that it allows us to plan and save for the future. Could you imagine a world without consumer banks? We'd all have cash stored underneath our mattresses with a lot more uncertainty about the future. But the most important contribution of a bank is actually what happens after a deposit is made. Say I go down to the bank today and deposit $10,000. The bank has something called a reserve ratio requirement. That's something that's set forth by the government and basically says how much the bank has to keep of that deposit in reserves as cash and how much it's able to flexibly do whatever it wants with it. Let's say it's 25%. $10,000 deposit, $2,500 has to stay in cash, but that $7,500 can be repurposed and help the bank generate a return. Say in the form of an investment as debt and giving out a loan. Now, debt has a lot of negative connotations associated with it, but it is incredibly important for how we're able to grow as individuals, as units, and as a society. Because what debt allows somebody to do is to achieve something greater than what was originally within their means. And so that bank is able to loan out money for someone to get a mortgage on a house or a loan on a car. And again, there's not to say that there's a lot of problems with debt in terms of predatory pricing or financial inclusion and access to capital, but at its most basic form, it allows us to achieve more than we otherwise could. Now, at the very top of our list and the number one spot is impact investing. Impact investing is like your traditional investing where you're trying to generate some financial return. But in addition to that, impact investing also seeks to generate some measurable social or environmental benefit as well. Impact investing can take a lot of different forms. Maybe it's focused around improving people's well-being, health, and livelihoods, or it could also be focused around sustainability and combating climate change or reducing our reliance on fossil fuels. I am obsessed with impact investing. It's the idea of how do you make money and do good at the same time. A lot of my work in impact investing to date has been around energy access, water access, education, housing, biodiversity, climate smart agriculture. I've had a chance to work with some amazing social enterprises. Just to give you a sense, a company that takes landfill plastic waste and turns it into affordable housing units, a company working on new carbon sequestration technologies, a company working to deliver first-time energy access and electricity to rural populations. Because there's 600 million people on this planet that don't have access to reliable electricity, meaning you are twice as likely to be born into a household without electricity than you are to be born into the United States. And there are so many more extraordinary things that other impact investors are doing out there at the multilateral development banks, at the community development finance institutions, working across debt for nature swaps, green bonds, child lens investing. I'm going to refrain myself for now, but the point being that impact investing can make finance a force for good. It is the intent to generate some benefit for society, either environmentally or socially. It's the 3 Ps. It is about people, planet, and profit. Now, for all the good that impact investing might do, there are fields in finance like private equity that can be actively detrimental to certain stakeholders. The leveraged buyout is a brilliant investment in what is clearly a broken system. Now, if that resonates, you might enjoy checking out this video for my full explanation and analysis on how the industry could be changed for the better. Lastly, if you learned something today, please consider subscribing, especially because there's a lot more content to come around impact investing, and I look forward to seeing you in the next one.